Imagine waking up one morning to find your bank account closed, your savings gone. That was the reality for millions during the Great Depression. But what exactly caused the worst economic collapse in American history? Our story begins with the stock market crash of 1929. On October 24th, Black Thursday, and October 29th, Black Tuesday, Wall Street fell apart. Stocks had been artificially inflated by margin buying, where people borrowed huge sums just to buy shares. By mid 1932, nearly 90% of the market's value had vanished. The crash hit during the presidency of Herbert Hoover, the 31st president of the United States. Hoover initially believed the market would correct itself. He consulted Secretary of Commerce Robert P. Lamont and economic advisors who encouraged a limited federal role. Hoover trusted private banks and big companies to voluntarily stabilize wages. But the crash exposed deeper problems that couldn't be solved with speeches or voluntary promises. Number 2. Nationwide bank failures. After the crash came bank failures. Between 1929 and 1933, more than 9,000 banks shut down. People panicked and withdrew all their money. But banks didn't have the cash because they had made risky loans throughout the 1920s. Hoover met with the Federal Reserve Board and top bankers like Eugene Mayer, chairman of the Federal Reserve, but they hesitated to inject the massive liquidity banks needed. By 1932, Hoover finally created the Reconstruction Finance Corporation, or RFC, led by Jesse H. Jones, to loan money to failing banks. But by then, confidence was already shattered. Number 3. Business closures, mass unemployment, and the Dust Bowl. As banks collapsed, businesses lost access to credit. Factories closed. Unemployment hit 25% by 1933. That's 1 in 4 Americans out of work. On top of that, the Great Plains were hit by the Dust Bowls, with catastrophic storms beginning in 1931. The drought destroyed farms and forced thousands of families, known as Okies, to flee states like Oklahoma and Texas. President Hoover was urged by advisors like Secretary of the Treasury Andrew Mellon to allow the downturn to run its course to, quote-unquote, purge the system. This decision slowed relief efforts and deepened the collapse. Number 4. Decline in consumer spending and overproduction. In the 1920s, industries produced far more goods than Americans could afford. Automobiles, radios, appliances, all were mass-produced, but consumers were drowning in installment debt, buying now and paying later. When the crash hit, families stopped buying, factories kept producing, but products sat in warehouses. Hoover's advisors from the National Credit Corporation, including New York bankers Charles E. Mitchell and Winthrop Aldrich, attempted to restore lending, but their efforts were too small to reverse collapsing demand. Number 5. International trade collapse and tariff wars. Next came the collapse of global trade. In June of 1930, Hoover signed the infamous Smoot-Hawley Tariff Act, raising tariffs on over 20,000 imported goods. For more information on the Smoot-Hawley Tariff Act, you can check out a link to this article in the description box. He did this after consulting with Senator Reed Smoot and Representative Willis Hawley, who promised American farmers it would help crop prices. Economists, including 1,028 who signed a petition, warned it would backfire. And it did. Countries retaliated with their own tariffs. Global trade fell by more than 50%. Factories that depended on exports saw demand evaporate. Does this sound familiar? Number 6. FDR's, Franklin D. Roosevelt's, New Deal response and what it warns us about today. When Franklin D. Roosevelt became the 32nd President of the United States in March of 1933, he inherited total economic collapse. He immediately consulted his brain trust, advisors like Raymond Moseley, Francis Perkins, and economist Rexford Tugwell. And here is Franklin D. Roosevelt meeting with some of his brain trust advisors. And it appears that he may be signing some documents in this photo. Within his first 100 days, he launched the New Deal, created the FDIC, stabilized banks, created jobs, and ended the gold standard. Now, what does this teach us today? Back then, poor government responses like tariffs, political gridlock, and conflicting economic policies deepened the Depression. Today, the U.S. faces government shutdown threats, rising tariffs on foreign goods, unstable trade relationships, and federal policy paralysis. Economists warn that, just like the 1930s, a combination of trade wars and political dysfunction can trigger a recession or even another depression. And here's some information here on the screen defining the New Deal and its main goals. You can pause the video to read more here. Number 7. Federal Reserve mistakes and gold standard problems. The Federal Reserve made multiple mistakes. In 1928 and 1929, Federal Chairman Roy A. Young raised interest rates to curb stock speculation, but higher rates cut off credit to businesses right when they needed it most. The U.S. also stayed tied to the gold standard, which limited the money supply. Countries like Britain abandoned gold in 1931, but the U.S. didn't until FDR suspended it in 1933. Franklin D. Roosevelt worked with Federal Reserve Governor Mariner S. Eccles, who helped design monetary reforms that stabilized prices and increased money circulation. Number 8. Structural economic weaknesses. Deep problems had existed long before the crash. Banks had almost no federal regulation. Wealth was extremely unequal. Farming and mining regions were already struggling in the 1920s. During the New Deal, Roosevelt listened to advisors like Senator Carter Glass and Vice President John Nance Garner, who pushed for banking reform. The result? The Glass-Steagall Act and the FDIC. These reforms prevented banking collapses for decades. You can pause the video to read more information about the Glass-Steagall Act of 1933. Number 9. Psychological panic and loss of confidence. Crashes aren't just financial, they're psychological. People stopped trusting banks and the government and the economy. Franklin D. Roosevelt used his famous fireside chats crafted with speechwriter Samuel Rosenman to calm the nation. His line, "The only thing we have to fear is fear itself," restored confidence and helped reopen the banks. Number 10. Slow Recovery and World War II. The New Deal softened the Depression but didn't fully end it. Only the massive wartime spending of World War II, starting in 1939 and escalating after Pearl Harbor in 1941, returned the U.S. to full employment. The legacy of the Great Depression is clear. The federal government now plays a permanent role in stabilizing the economy. Social Security, federal jobs programs, bank insurance, and financial regulations were all born from this crisis. And today, economists warn, if political gridlock, trade wars, tariffs, or shutdowns weaken the government response, America could see some of the same warning signs that existed in the 1930s. Since there is no new thing under the sun, history does often repeat itself, and the Great Depression may be one of the clearest warnings from America's past. I thank you for listening. I thank you for watching. And remember, know your history.